Now, that can be countered by saying, yeah, but Jacob, the price of the property is going up 7% per year. Oh, okay, so I'm really getting 8%. Yeah. Oh, okay, well, that's different.
Yeah, so for argument's sake, you've got a risk premium of 4 and you've got 4%. It gives you a required rate of return of 8%.
Yeah, so you say to me, well, Steve, I can get 4 in bonds. Listen, mate, I want this stock or the property to yield 4% over that. Okay, well, Jacob, that means you want 8%, right? Or thereabouts, okay? Long-term average.
Yep.
Now, okay, so we know what you want now. You say, Steve, dude, I want 8%. I say, okay, the net rental yield, right, is roughly about 4%.
Yeah, in capital cities.
In 2015.
Yeah.
Right, so at the moment, excuse me, it's about 2.5 to 3.
Oh, is it? I haven't looked at it.
In fact, it's probably lower. So in other words, that's, fairly unattractive.
And this is in capital cities as well.
Yes.
Yeah.
So next slide.
Next.
Righto.
Bang.
Okay. So now to calculate the net rental yield, subtract all the expenses that an investor must incur. Okay. So you're talking about property management fees, maintenance, insurance, capital costs, right? The loan, all that sort of stuff.
So
okay?
1% is a reasonable number to deduct.
Yeah. So you say, okay, the net yield is 4, right? But it costs me about 1. Okay. So the real yield is about 3.3.
Yep.
Okay. So that's the final number required is the long-term growth rate in rent. Okay. As shown in the chart, which is not here, the figures above 3 may be reasonable. Okay, so let's assume 3.2. So in other words, I'm putting the rent up 3.2% every year.
Yep.
So now I can calculate the valuation, right? So put them together, divide the annual rent earned on the property, right, by the divisor, which is calculated by subtracting the long-term growth rate from the discount rate.